a business doesn't have to keep growing to achieve an epic outcome for its founder or founders. The revenue peaked in year 2 and has been on a downtrend for the next 9 years. Profit also peaked in year 2, has been on a downtrend, but has only dropped from a peak of 2.9 to roughly 1.6 now. Quick one, we talked about Relo last month, and honestly, it's become our go-to for team tech. Every time we hire someone or bring on a contractor, instead of dropping a huge amount up front, we just subscribe to the latest tech through Relo Business. This month, we've been looking at the new HP laptops, and with a MacBook Pro 5 rumors floating around, it's nice knowing we can upgrade without being locked in. It's a simple way to keep the team feeling motivated and equipped. The link is in the show notes. Hello and welcome to this very special episode of Cash Machines. You'll note that the name of the show is now Cash Machines and no longer Confessions of a B2B Entrepreneur. This is because we are rebranding people. Yes, we're changing. What I have learned about content creation over the past actually decade of trying to do it is that you're only really going to win if you really love and enjoy the content you create. And so if long-time listeners may be aware that this show actually started as Confessions of a B2B marketer, and then after 3 years transitioned to Confessions of a B2B entrepreneur as I got less interested in marketing stuff and more interested in entrepreneurship. And then I found myself getting a bit less interested in conversations with B2B entrepreneurs where we weren't really talking about anything interesting to me. For me, the most interesting thing about business is cash flow. And so what I also see in the world of content creation for business and entrepreneurs is that there is an almost obsession with the other way to make money, which is capital gains. So if you think about TechCrunch, for example, they're all about how an entrepreneur would increase the value of their ownership. Like this new company has now received funding of £10 million at a post-money valuation of £60 million, so the shares have increased as much. And the reality of that game is that the majority of entrepreneurs don't actually make any money from their business. And if you think about 99% of all the people that have got rich for the history of time has been through cash flow and not capital gains. And so what I want to do with this show now is rebrand to Cash Machines. And each episode is either going to be a solo episode of me talking through a cash machine that I have found, or we get the founder of that cash machine on the show to talk about the cash machine they have built. Let me quickly elaborate on what I mean by a cash machine. The reality is that every business owner or every entrepreneur, in my opinion, their goal should be to build a system where one of the outputs is cash or free cash flow or EBITDA or profit. And fortunately, there are places on the internet where people will share how much cash flow they're making. And so one of my key tasks to add value to you is to go out into the internet and find these businesses that are sharing how much cash flow they're making and then summarize it for you with insights explaining how we think or how I think they're doing it. Now, of course, the other angle is to get people onto the show and have them share it. And so we're going to be doing both of these. If I find a business that is clearly profitable and I can work out how much money they're making, then I'll break it down for you. At the same time, I may just reach out to the founder or entrepreneur and ask them to come on the show so they can do it in an episode. And so what we're going to do in today's episode is break down a cash machine that I've been aware of for many years. And fortunately, this business gives monthly, or they actually don't anymore, but they did give monthly income reports. This is a trend online for bootstrap businesses where they break down how much money they made and how much money they spent, and therefore how much profit they have made. And so that's what we're going to be doing in this episode, focused on, you named it, the Entrepreneur on Fire podcast by John Lee Dumas. Been running since 2014. John Lee Dumas is an OG in the podcasting entrepreneur coaching space. And in today's episode, we're going to be breaking down how much money they've made over the past decade, how much revenue, how much profit, and also why I think they've been able to do that and sustain profitability for a decade. One last thing before we jump in, what I'm going to do with each of these breakdowns is have a similar structure. So I'll first do an intro to the business and the founder so you know who they are, what type of business it is, etc. And also explain how they make money. And then we'll jump right in and talk about how much revenue and profit they're making. We'll look at how that's trending over time. And then the core meat of the episode is going to be why I think it's working. So we'll break down 3 reasons why I think they're able to make this profit and sustain over time. Then we'll try to understand what that profit or cash flow is being used for, whether that's being reinvested into the business or taken out of the business and the founder entrepreneur is investing in other stuff. And then we'll also pull out one big learning from the whole study that I've done. Okay, let's jump in. So John Lee Dumas is an OG who was podcasting before podcasting was a thing. Go to eofire.com now to check out the show and check out the ecosystem John's built around the show. But the show started in 2014 and really, from what I can see, has had a relatively similar structure for the whole decade. It is a daily show, and each day is a relatively short interview with an entrepreneur. Like quite high energy. John's the high energy host, has some similar questions. He has a fire round at the end of every episode. So like very textbook podcast media play. But what John has done is he kind of paved the way for all these other entrepreneur podcasts out there. There probably wasn't that many when John started in 2014, and now there's shitloads. So shout out to John for pioneering that. But of course, he also got paid well for doing so. So the business type is media. So John essentially creates information, and then in that information either includes ads to his own things, ads to other people's things, or affiliate offers to other people's things. So sponsorship, he's getting paid up front. For affiliate offers, he is sending people, and if they buy, he gets a cut. And then obviously if he's selling his own things, which has been courses, coaching, and physical items like journals, for example, he's obviously making money on those. But exactly how much money? So all-time revenue, which is pretty incredible. Like obviously no money. They didn't take a big seed round, for example. I don't know the exact amount of money that John put in to start the company, but I can imagine it wasn't that much. But so from 2014 to 2024, the business has made close to $28 million in revenue with close to $22 million in profit. So that's a lifetime margin of 79%, like very, very juicy. But let's look at the trend over time. So there'll be a chart that we will link to in the show notes that shows revenue and profit every year. But essentially, we started around $2.9 million in revenue, just over $2 million in profit in 2014. Peaked, that's the important point. We peaked at $4 million in revenue and just under $3 million in profit in 2015. Like that was the peak for the whole company. But imagine that $3 million in profit for a business in year two. Absolutely incredible. And then from there, essentially, the revenue and profit, or the revenue, have gone down. 2024 revenue is 1.8 million, so halved over those 9 years. What's interesting, though, is that the profit in 2024 was 1.6. So obviously roughly half of the 3 million in 2015, but profit was around 1.6 in 2018. So that has remained from 2018 at least through to 2024 relatively flat. The revenue is going down, profit is coming down, but not at the same rate. Profit has increased, and therefore obviously margin has increased over the decade. So essentially what's happened is that the revenue mix has changed during that time, e.g. more focus on sponsorship, very high margin revenue, less focus on physical products and products that take up more time, for example, coaching and cohort courses. For example, John had a big course called Podcasters Paradise, which did peak, of a revenue for that did peak in the early days of the company, but now has essentially gone to zero. So there's been a real focusing on where the business gets sales or makes revenue in order to conserve that margin over time and probably give John and his wife, who's also in the company, we'll talk more about that later, a better lifestyle. Essentially, John's job is literally just to find the guests. I'm sure all the guests are coming in by now because it's such a big show. Run the episodes really well to maintain the audience and then sell sponsorships, simplify the operations in the business. So if we look at margin then, around 75% for the first 2 years, and then has steadily increased up to the 96% that we're seeing since 2022. So for the last 3 years, margin has gone up. So essentially, John's been able to take £22 million out of the company over the past decade, roughly £2.2 million a year. So the next question is, why do we think this is working? So number one, lean team. In the data that we saw, John's paying roughly $12K per month in payroll. So it's 3 VAs. And I don't think that includes a salary for John and his wife, Kate. It seems to me take the money out as profit after, and we'll talk again more about how much corporation tax they're paying. But $12K per month in like operational expenses compared to between 2 to 400 grand in revenue they're making is obviously very lean. So these VAs are based in the Philippines. They have very clear working procedures and very clear tasks and roles that they need to focus on. I don't have the exact info, but in my mind, to run a podcast like that and to run the operation, there's probably someone doing admin, guest scheduling, etc. probably someone either doing the editing themselves or managing the editors, and then probably someone on the website, et cetera, doing the operations, ensuring the content is released and promoted. So clearly defined roles for each VA. So essentially what John's doing, again, I haven't spoken to John, hopefully he'll come on the show, but he, in my mind, is probably just approving guests, coming on, recording episodes. They'll likely be batched, but if he's releasing one per week, they need to record 20 per month. So one per day, they need to record 20 per month. So John is likely, let's say, an hour per episode. So 20 hours per month recording. So 2.5 days, with probably batched over probably like 5 days he'll be recording. And then his other job is probably just sales on sponsorships and then working out other things to sell. I know right now there is another course that John has released, but as it stands, the revenue is largely sponsorships. I'm not entirely sure what John's wife Kate does. So that's the first one. Lean team, controlling the cost to maximize profit. Number 2 is zero customer acquisition costs. So again, the bulk of that $28 million in revenue has come from sponsorships. Now, in any business, generating revenue often costs money, e.g. we call this marketing, sales spend, or customer acquisition cost. The great thing about John's business is that the ideal listener is also the ideal customer. So the people that consume his content would also probably be good sponsors of the show. John targets, as you can tell by the name, entrepreneurs. Entrepreneurs have businesses. They often need to reach other entrepreneurs or other businesses, which is the people within John's audience. So there are a couple of income reports, or most income reports, where John's marketing spend is zero because he simply needs to put an ad into the show or send a link in his newsletter to offer sponsorship positions. And then he gets those sponsorship positions filmed. So in essence, his product is also his marketing. The podcast also finds the customers as well as delivering the revenue through sponsorships. Number 3, tax arbitrage is a simple one. So in 2016, after the first 2 years where John, it seems, made between $4 and $5 million in profit, was living in California paying income tax of presumably 30%, moved to Puerto Rico to pay 4% income tax. So as it stands, it's likely saving him around $600,000 per year just to move to Puerto Rico. That's the difference of 26% income tax between Puerto Rico and California. So $600K per year simply for leaving the country. I don't know the exact rules. I don't know how limited John will be from going back, but presumably he can spend some time in the US. And obviously he gets to spend time in a warmer, apparently a really nice country I've never been myself. So those are the 3 reasons why we think John's been able to sustain this level of profit: lean team, zero customer acquisition cost, and the tax arbitrage through moving to Puerto Rico. Okay, so what do we think this cash flow is being used for? So from our research, we found that most of the cash that John takes out of the business, and actually most of the cash from what we can see is being taken out of the business, goes into low-cost index funds. So specifically Vanguard, presumably trackers of the S&P or the NASDAQ, where you just put in cash every month. Relatively stable, should grow or does grow on average at 9% per year. Is obviously susceptible to some drawdowns, but maybe there's also money going into bond index trackers as well. So very simple, very safe. He has a big house in Puerto Rico, so this is the primary residence. He also bought a beachfront condo in Marbella, which is in Spain, in Europe, from his parents, which is now listed on Airbnb, so presumably is getting a nice yield on that, and did invest in crypto in 2021, even launched a mini-series of the show called NFTs on Fire. Not sure how that went. Presumably, if John didn't sell, those assets or NFTs will likely be a little bit down now. But what we can see, there's a large amount of cash being invested back into assets in the business, largely being taken out, invested as we see into real estate, a little bit of crypto, and the low-cost index funds. There's also some funds going into charity. So he's a major donor to Pencil of Promise and has been funding multiple schools in places like Guatemala, Laos, and Ghana. So shout out to John for doing that. So assuming that the bulk of the $22 million in profit over the last decade have been taken out, we can assume John's net worth is around that mark. Again, like if the money started going into low-cost index funds a decade ago, it likely has increased significantly, potentially even doubled. So we may be looking at a net worth of between $20 to $40 million. But then John obviously still owns the asset right now, which is throwing off around between $1 and $2 million in cash every year. So John's net worth may be $20 to $40 million with cash flow of between $1 or $2 million per year. So very, very healthy position. There is obviously the question of the value of EOF. And this is quite interesting in that it's probably quite hard to sell. He could sell it, but then in order for the new owner to maintain the value, John would have to still work there. And so he'd have to sell it and essentially become a contractor or an employee, which presumably is not what John wants. He's obviously passionate about entrepreneurship. So probably can't sell, but really, why would you need to sell unless someone's going to pay you a big multiple? And someone wouldn't pay a big multiple for this because of that key person risk. So John clearly has been able to build a lifestyle he likes. He presumably enjoys into entrepreneurs, and that's what he's spending most of his time doing. And so he gets to spend most of his time doing that, whilst also being paid between $1 and $2 million per year. So great setup. Let's now summarize the main learning from this. And for me, it's that a business doesn't have to keep growing to achieve an epic outcome for its founder or founders. The revenue peaked in year 2 and has been on a downtrend for the next 9 years. Yeah, profit also peaked in year 2, has been on a downtrend, but has only dropped from a peak of 2.9 to roughly 1.6 now. So it's a slow shrinking of profit from a very healthy start. Obviously, you're assuming the limited or zero amount of capital that was initially invested into the company. So a business doesn't have to keep growing to be an epic outcome. For example, John, he's still raking in that $1 to $2 million per year for presumably not working that hard. So it's just a really epic example of what seems to be an enjoyable and low stress business for the founder that is very healthy, of providing a very healthy stream of cash for the founder. So massive amen to that, and shout out to John and Kay, obviously, for building and maintaining this very profitable asset. Okay, I hope you enjoyed this new version of the show. It's called Cash Machines. Today we covered Entrepreneurs on Fire. If you know of a business that is profitable and is happy to share numbers, then just let me know. Drop me an email, tom@tomhunt.io. I will study it. I'll create an episode, and I'll also reach out to the founder to see if they want to come on. And I hope you enjoyed this. Any feedback, please send it to, again, tom@tomhunt.io. We must give a massive shout out to Fame, who produced the show. So they do the editing, they help me with the research, etc. If you'd like a show like this, go to fame.so, request a proposal. And then finally, if you have any feedback, again, instead of emailing me, it's probably better if you leave a review on Apple Podcasts, then email me with a screenshot, and then I'll give you a shout out in a future outro of the show. Thank you so much for listening.